Let's look at a brief example of how to prepare our 4 primary financial statements from scratch. And we always start first with the income statement. These all flow from one to the other, so we have to prepare them in order. And something else that I need to note here is all of our financial statements begin with a header. So we know we'll have the company name, the actual statement, and then most of them say for what period is ended. So this will be our income for the month of October, for the month ended October 31st. And I'll point out the other one to you that varies. So we have to think about what goes on an income statement. And the way we calculate income is by taking our revenues minus our expenses. So we have to look up here and figure out what are revenues and what are expenses. Well, I'm going to go through just to save a little time here. And let's actually figure out what each of these different items are. So cash is actually an asset. So I'm going to put an A here. Accounts receivable is a type of asset, again, when our customers owe us money. Supplies is an asset. Those have value. We can sell them if we need to. Land is an asset, something a company owns, as well as equipment. Well, accounts payable, those are liabilities. Those are monies we owe to our suppliers. Common stock is equity. That's a form of equity. Remember, there's 2 components to equity, common stock and retained earnings. Dividends is actually part of our equity as well. It decreases our equity. Consulting fees are revenue, which is part of our equity. We've got expenses. Those are also part of equity. Remember, they decrease our equity though. Okay. So now we need our revenues minus our expenses. So it looks like we need to focus in on this component of the information. So our revenues are going to be the consulting fees earned minus our expenses. So let me go ahead and just remove this block here for you so you can see what we got. So we start with the revenues and we'll list those out. In this case we only have one, which is consulting fees earned for $15,000. Then we're going to list out all of our different expenses. So we had salaries, rent, telephone, and miscellaneous. And then we will list out the associated amounts tied to those particular expenses. We're going to add up all of our expenses, so that's going to give us total expenses of $98.90. We take our revenue of $15,000 minus our total expenses of $98.90. That tells us our net income is $5,110. Okay, don't forget that. We're going to need to know that. $5,110. Remember, these are prepared in order. I need that number for the next financial statement, which is our statement of retained earnings. Okay, so statement of retained earnings is the second statement that we need to prepare. And again, we always start with the header, company name, in this case, Real Solutions. The statement of retained earnings tells us what statement it is. And this is also for month ended October 31st. So these always look the same, or pretty much the same, and it always starts with our beginning balance and our retained earnings. Well, this particular company didn't have a balance prior. It's a brand new company. It says a new consulting firm, so they didn't have any savings, so they're going to start with a 0. There's no retained earnings to be had. Then we're going to add net income. Well, we just calculated that here from our income statement, $5,110. So we're going to go ahead and add that. Then we subtract out any dividends that are paid. So any dividends, do we have any dividends up here? Oh, we did, $3,360. So we're going to need to subtract those dividends, and that's going to give us our ending balance in our statement of retained earnings. So you take your beginning balance, and again, we didn't have a beginning, it's a new company, plus net income minus dividends gives us our ending balance in our statement of retained earnings. Now again, we're going to need that ending balance for the next statement, which is our balance sheet. So $1750, everybody remember that number, $1750, ending balance in our statement of retained earnings. Just one other side note here too. All of the statement of retained earnings follow the same format, except if we had a net loss and no net income. If that's the case, we would subtract the net loss along with the cash dividends, and obviously we would have no net income to add. All right, let's look at our balance sheet. Balance sheet is our ALE. You guys know what ALE is now? Assets equals liabilities plus equity. That's what goes on our balance sheet. So I like to tell people, if you drink too much ale, you get out of balance. So that should help you remember what what goes on your balance sheet. So earlier I detailed what was assets, liabilities, and equity. So hopefully you remember. And we will list all those out on our balance sheet. So let's start with our asset side of the balance sheet, and we will list out all of the assets. Remember, we had cash, accounts receivable, office supplies, land, and office equipment. Those are all assets. They're all things a company owns that has probable future economic benefit. So total assets for this particular company are $83,250. Now my equation has to stay in balance. I'll show you what that means here in just a second. Liabilities, we only had one, which was accounts payable. So I'm going to list that off here as well. Now I'm listing it on the right hand side of the balance sheet. You can also stack them, so you could list your assets on top, then liabilities and equity below that. That's just fine. So our accounts payable, then we need to figure out what our equity was. And we had revenues and expenses, which showed up on our income statement. Dividends went on our retained earnings. So right now all we have are our common stock and retained earnings. So, let me get rid of that. So common stock, 74,000, that's the balance we showing on there. Retained earnings of 1750. That should have come from our statement of retained earnings, and it did. Again, we have to complete that first so we can fill out our balance sheet here. So our total equity, if I add common stock and retained earnings together, is $75,750. And then my total liabilities of $7,500 plus my total equity of $75,750 equals $83,250. Now you can see here, and I just want to point this out because it's very important, my total assets of $83,250 equal my total liabilities plus equity of $83,250. If those two do not equal, you made a mistake. Something is wrong. Something I like about accounting, it does flag you when you make a mistake. Alright, let's skip down to the statement of cash flows. This one is usually prepared last, and it follows a slightly different structure than the others. Okay, for our statement of cash flows, we're going to have three headers: operating, investing, and financing activities. And we're only concerned with items that actually impacted cash. So I like to tell students when we're completing these problems to actually kind of just walk through each one of these numbers, and you can cross them off somewhat as you go. So again, only with statement of cash flows, we're only concerned with the items that impact cash, and then we're looking at those three categories, which are operating, which are from our everyday business activities. Those are our revenue and expense generating activities. Our our investing activities would deal with our long-term assets, property, plant, and equipment. And then our financing activities would deal with how we're getting our money from external sources, whether it be stockholders or investors, or loans for that matter. Okay, so this is a little hard to work here, but we'll do our best. So it says the owner's initial investment consists of $38,000 cash. Okay, so the owner is going to bring in $38,000 in cash, and in exchange for that cash, he's going to get stock, right? So this is our financing, or a financing activity. And then it also goes on to say that he also contributed $36,000 in land in exchange for stock. Well, this is land, it's not cash, so we don't care about that component on our statement of cash flows. We're only concerned with cash inflows and outflows on our statement of cash flows. Then it says we purchased $28,000 worth of equipment in cash. And again, we have to think about, well, is that an operating, investing, or financing activity? Well, it's going to be an investing activity because it deals with long-term assets. Our accounts payable balance of $7,500 consists of $4,250 in office supplies purchased and $3,250 in employee salaries not yet paid. Well, this really isn't important until we actually pay those. The only thing that's going to catch us here, I think, are these salaries of $3,250 that's not yet been paid, because it tells us up here our salaries expense was $6,000, but but we haven't yet paid $32.50 of that. So that will tell us what actually was paid, which I think is $27.50. So we need to remember that on our statement of cash flows. Then it says the company's rent, telephone, and miscellaneous expense are paid in cash. So we've got rent here, our telephone, and miscellaneous expense. Those are all operating activities. We have to pay those bills in order to operate our business. Then it says $2,000 has been collected of the $15,000 in consulting fees earned. So out of this $15,000, we received $2,000 in cash. So that's obviously going to impact our cash flows, the operating section. So let's turn the page here, and I'm just going to scroll down so you can see. Again, we start with our statement of cash flows. Oops, I didn't mention something. Let me do that real quickly. On our balance sheet, you're going to notice that we have, instead of 4 month ended, this is a date. So as of this date, these are my assets and my liabilities. That's the only one that's a date. All the other ones are for a period ended, whether it be quarter, month, or year. So here we have Real Solutions statement of cash flows for a month ended, and we'll list our operating activities first. That's going to be all the inflows and outflows from our daily operating activities. From our revenues, which we saw a second ago, $2,000 collected of the 15 of consulting fees earned. We also have cash paid to our employees. Remember, we hadn't yet paid a certain amount of that, but $27.50 had been paid, and then we'll list out our other 3 expenses that had been paid in cash. So inflows are monies coming into the business from our customers. Outflows are going to be for expenses. Fortunately, our outflows exceeded our inflows, which isn't abnormal for a new business, by $46.40 from operating activities. Then we would list out our investing activities, would deal with our long-term assets. And again, remember we bought some office equipment for $28,000. That was letter B here. And that was also an outflow of cash once we paid for that. And then we had some inflows of cash from financing activities, and I'll show you what those were. So we had a stockholder investment of $38,000, which was letter A. We paid dividends to stockholders of $33,600, which you can see up here. It says cash dividends $33.60. Take the inflow of $38,000 minus the outflow of $33.60. That tells you we had cash provided from financing activities of $34,640. Now we're going to take our outflow from operating activities, add to that the outflow from investing activities, and then we get to subtract that from the inflow we had for financing activities. Basically, we're just adding all these operating, investing, and financing activities together to get a total inflow or outflow. And in this case, if we do that, the $46.40 plus the $28,000 minus the $34,640, we get a $2,000 inflow or increase in cash. We had no beginning balance because it's a new company, so the ending balance in cash should be $2,000. Also, just another note here, this $2,000 that we see as our ending balance in our cash should also be the balance that we saw on our balance sheet, which it is. So we're in good shape. These two have to match. Okay. Hopefully that clarifies things for you just a little bit, gives you a nice example to work through. Thank you.